Good evening and welcome to our webinar this evening. This is Garth Davis. I'm the founder and the CEO of Property Powerhouse. Thanks for joining us this evening for our webinar. Tonight's webinar is it's tax time at the moment, so a lot of you I'm sure are looking at tax options and looking hard to reduce tax and best ways to save tax this financial year through smart property strategy. So thanks very much for joining us tonight. It's sweet, short and sharp. We're going to have you in and out in 30 minutes. There will be opportunities to ask some questions, and after the event we will have a little bit of a feedback session, so to get some feedback from you. All right, so just on to our next slide. So just an introduction and disclaimer. So this evening I'm hosting this, Garth Davis from Property Powerhouse. We have the pleasure of Mike Pilkington of Asset Financial Accounting. We coming to you live from his offices in Perth. So just a disclaimer, please, all information presented in the webinar is general nature only. Individual circumstances will differ. So please read through some of the disclaimer there, and please, we do encourage you to get third-party and specialized advice. All right, so our specialist speaker this evening is Mike Pilkington, that good-looking bloke up on the right-hand side there. So Mike is a degree qualified accountant who founded Asset Financial Accounting in 2009, has experience in property, is an investment property owner himself, has worked in some real estate sales. I didn't even know that, Mike, so that's really interesting, and is really passionate about property. So we're talking to the right people, and Mike has a very good understanding of the tax aspects around property and how we can try and manage and minimize your tax on investment property. So good evening, Mike. Thanks very much for joining us on the webinar this evening. And obviously tax time is sexy at the moment, and we're looking to try and get a few gems and pearls of wisdom. So good evening and welcome.
Thanks very much, Garth. Thanks for the introduction. Thank you for the opportunity of speaking with you this evening. I hope you get some value out of the webinar. We've kept it, as Garth is, rather short and sharp and to the point, but certainly welcome any feedback and any particular questions you may have. Right, so if we jump in, this going to our goals for the webinar, we're going to look at how can we potentially legally maximize your tax obligations this financial year. Emphasis there obviously on potentially and legally, two very critical words in that sentence. Why you should engage a qualified accountant to prepare your tax returns, your annual returns, the risks of doing a DIY annual return. Obviously the temptation is there to try and save the odd dollar. That's not always the most economical way of doing things, as we'll see as we go through, and how to potentially enjoy the benefits of tax deductions through the financial year, so you get benefit through the year rather than waiting for tax time at the end of next year. So jumping in with maximizing your tax deductions, obviously we're talking with property investors here, so some of this may be old news to some of you guys may be new property investors having come on board with Garth and his range of properties that he promotes. So it is very generic in nature, so please bear with us through that. Obviously some of the more common deductions that you can claim, if you're using a professional property manager, all their costs of managing your property, the inspection costs, advertising for tenants, that type of stuff is all tax deductible. It's all part of generating the revenue that you receive from your rental property. Interest paid is an interesting one. We find quite often clients may have a line of credit or a mortgage that is on the back of their existing primary residence. This can cause you grief down the line. We do need to split that out between business and personal use. So in other words, what's your home loan for your private residence and what's for your investment property. Related mortgage costs, again, breaks down into two different elements. You've got capital costs and you get your revenue costs that you can deduct. This is a bit of a complicated area. I'm not going to spend too much time on this, but there are different costs that you can claim at different times. Your repairs and maintenance of your property. This is where a lot of people come unstuck. It is a very complicated part of tax law in terms of defining what is a repair and maintenance, what is an improvement. something that the ATO picks up on absolutely every financial year because people get it so desperately wrong. So what may appear to be a standard repair and maintenance to the general man on the street is not necessarily as the ATO will see it.
And Mike, that's an area the tax department is really zooming in on this next tax time. Is that correct?
Very much so, Garth. Yes, they have advertised that it's on their radar because of the fact that so much is taken incorrectly. It does create a huge black hole. So we need to be very, very careful in that respect. Certain prepayments subject to limits. For example, if your insurance, you can prepay your insurance for the following 12 months, prepay your interest on your mortgage or your investment mortgage for the next 12 months. It cannot exceed a 12-month period. So it's literally just for the next 12 months. But having said that, one obviously needs to take into account your personal cash flow. You don't want to put yourself in a position where you're cash strapped trying to save tax.
Yes.
If you've got the ability to put that money in there, go for it. You can get that deduction this year. Obviously, swings and roundabouts, you're going to get a deduction this year, you're going to miss out next year. So it's just a matter of weighing up your options and making an informed decision. But again, that's a discussion we have with your accountant.
Perfect.
Okay. Council rates and taxes. Most councils offer you the ability to pay your rates and taxes in 4 different quarters.
Yeah.
Bear in mind with this, you can only claim what you physically paid. You may receive a bill for $1,000, $250 a quarter. If you've only paid 2 quarters, you can only claim $500. You can't claim what you haven't actually paid. Insurance premiums, likewise, again, you can obviously prepay those if you've got the cash flow to do that. Cleaning and garden maintenance. This is one that quite often gets overlooked. But if you've got, your end of tenants have moved out, you've got your end of lease cleaning, you can claim that. Your garden maintenance, having the lawnmower man go in every week, go and mow the lawn, do the general garden maintenance. That type of expense is deductible. But on the flip side, if you are, as a property owner, recouping that from your tenants, that does become part of your taxable income as well. So just be wary of how you work with that. Potential deductions available carried on. Obviously, the biggest one you've got is depreciation. Again, it's broken down into 2 different areas. You've got depreciation on the building, and you've got depreciation on the fittings and the fixtures. The building is depreciated 2.5% for 40 years.
Yeah.
So it is quite a standard deduction that is available. New home through Garth, for example, we've got everything nice and brand new in the property. There's no need to go and spend anything. That is all depreciable.
Yeah, be on depreciation schedule.
Absolutely right. Absolutely right. We'll address that in a minute. But if you're buying a second-hand, you've got to call it a second-hand property, otherwise when it's already been used as a primary residence or as an investment property, you cannot claim depreciation on the second-hand goods. So, for example, the previous owners put in the new carpets and new window treatments prior to selling, you cannot claim depreciation on those items. It's only stuff that you put in after your ownership of the building has commenced that you can start to claim that depreciation. Be aware of these rules that came in May of 2017, so they are fairly new in the market, not necessarily hugely well known, but it's one of the potential traps that you can fall into if you're not looking out for them. Depreciation is applicable on other structural improvements. Again, something that your structural engineer would have a look at when he comes up and does your depreciation schedule. There are experts out there who will do this. It's worth spending the $700 or $800, which again is a tax deduction, to get a proper depreciation schedule set up. You only need to do one over the lifetime of the property. You don't need to do it every year. The engineers will break it down into what's your capital works portion and what is your normal depreciable fittings and fixtures. The only time you may potentially need to do a new depreciation schedule is if you've had significant changes to the building. For example, you put in a second story or considerable renovations, that type of thing, you may need to go back and do another property schedule. But generally, they last a year and they give you all the information you need to be able to claim your depreciation going forward. The interesting one, the professional accounting versus a DIY and annual returns. This is the analogy most people look at and makes sense is, would you go to your car mechanic for a heart transplant, or would you go to a professional surgeon to do the job? It's pretty much the same when you're trying to look at a DIY versus going to somebody who's actually qualified to do this, to do your tax We spend time at uni, we've got practical experience, we know what we're looking at, we're up to date with the changes in the legislation, which change incredibly regularly. Tax office is always out to try and close the loopholes. So unless you're absolutely completely on top of the changes in the law, you could potentially come unstuck, which does obviously have cost implications for yourself. It could open you up to tax audits, which could have penalties and interest, as well as the inconvenience and the absolute stress of having a tax audit. Some of the pitfalls that people generally fall into is items such as when is an expense a capital expense, or when is it a normal revenue expense that you can write off. Examples of capital expense might be, for example, you remodel your bathroom. You've taken away the old plastic shower curtain and put up nice glass frames and so on and so forth. The ATO is going to look at this and say, well, that's not a depreciable expense. You can't claim it in the year that you put these improvements in. It's not a repair and maintenance on a wear and tear, so in other words, it's not deductible. So you don't get to the end of the financial year and think, well, I've got this pot of money, I'm going to get an instant write-off. It doesn't happen. Where you've got a genuine wear and tear replacement type thing, storm damage with winter now, because the storms coming through, roofs get lifted, that type of thing, that will be seen as a repair and maintenance.
Water coming in through the drains, and
absolutely. That's your normal wear and tear type stuff. But the new pergola out the back, or the new deck, the glass fencing around the swimming pool, is all capital, not deductible. Okay. Other common pitfalls that a lot of people fall into, particularly on renting out to family members, friends, etc. When you rent your property out below market value, that has a very negative impact on your depreciation, in particular, the amount of interest you can claim on your mortgage is all impacted by that type of thing. So always advisable, if you're renting out to your friends, your family, this type of thing, get a real estate agent in, somebody who can give you advice as to what is a market value for that particular property. It's generally advisable get that in writing from the real estate agent. They don't obviously charge you for it. It's a free service, but at least you've covered your back as to where you're going with it. Again, personal use tying in, particularly if you're thinking of things like holiday homes. A lot of people have properties, say, down in Andrew or down south, which they rent out periodically, and the rest of the time it's quiet, they go down and stay there for themselves. While it's a personal use, you cannot claim the expenses related to the property for that period. So it is added back to your income. A big change in the tax law, and this came in a couple of years ago now, probably about 2 years ago, relates to your travel expenses. You used to be able to claim a certain value of money to go and have a look at your investment properties. So, for example, Garth, if you were going over to the eastern states, you go look at a property there, you could claim your airfare, that type of thing. For us local people, you could claim to go and investigate your property, drive by, etc. That deduction was gone. It was obviously a loophole. The ATO is now closed. Not common knowledge out there that people no longer can make that deduction. So something that they've been trying to put through is going to come back and bite you, so you can't do it. The availability of the property as an investment property, again, ties into a certain degree with your personal use. But if you're buying a property through Garth that's being constructed, it's the time from the period that the property is available for rent. If you're building a new property with the intention of going straight into a rental, it's not such a drama. If you've got an established property that's been built a year ago or whatever, you put it back onto the rental market, it might stand open for 2 or 3 months. That is still available to get the deduction, provided the property is available to do the right marketing, etc., to create interest for people to come and rent your property. You'll still be able to get that deduction. If it's empty and you're not genuinely looking to advertise that property to put people into it, it's just standing empty and it's not being promoted, the ATO will look at that and they'll say, well, it's not being used as an investment property and not allow the deductions. So be very careful in that respect. A big issue that we're seeing at the moment is how common it is these days. It is Airbnb. People are renting out their rooms when they go on holiday and this type of thing, and they're not declaring the income. That is a problem. The ATO are watching these types of things. Any rental that you receive, when you've got international students in your room, whether you've got, is it be an Airbnb when you're away, this type of thing. It's all income that you need to declare on your tax return. It's stuff that the ATO will clamp down on, so be aware of those. The exception to that, most of us, those of us who've grown up kids that haven't moved out and they're paying board and lodging, that is an exception. That's regarded as a domestic arrangement, and therefore you don't declare that on your tax return at all. So that you just be aware of those sort of pitfalls when you're doing your tax return. Again, something that a professional accountant will be able to help you with. Slides here.
All right, just talking through the next slide there.
The big one that a lot of people don't know about, and what the seminar really is revolving around or building up towards, is the ability to enjoy the benefit of a tax deduction during the financial year. You've seen Garth, he's shown you a wonderful property, he's got a lovely selection of properties out there to choose from. They're being built, obviously while the construction period is going forward, you're not receiving income, but you're incurring costs. Even once you've got your construction period is completed, you've got your tenant in there, obviously you've still got the costs of maintaining this property in terms of interest, etc., etc. There is a ability out there to apply for what's known as a PAYG variation. It's you go through your accountant, you fill in a particular form which takes into account your income, your expenditure related to this particular investment in terms of a property. We fill out certain information, we send it off to the ATO, and they do an assessment, and they come back and they say, yes, okay, this looks realistic, we can work with this, and they agree to vary your PAYG rate. So as an employee, you're already being taxed at whatever your marginal rate is by your employer. Come end of financial year, you're sitting with your accountant, he says to you, right, okay, you've had rental income of this amount, you've had deductions of that amount, you owe this amount of money to the tax office, or you're getting a refund of this amount of money at the end of the year. But that's a 12-month gap that you're waiting for this money either to come back or to pay it out. By taking into account, particularly when negatively geared properties, taking these expenses into account during the year, you can actually save yourself money. So instead of waiting for a huge refund at the end of the financial year, you're enjoying those benefits through the course of the year.
It helps you with cash flow with your properties, particularly if you've got more than one.
Absolutely.
Helps you get the cash flow a little bit faster to help you hold them month on month.
Yeah. Absolutely right. And not only that, but it gives you a safety net if you have an unexpected expense. So you've always got that cash on hand. The important thing to realize with these PAYG variation applications, they are valid only for one tax year. You have to have them in with the ATO. The application has to be made by the 30th of April. And it's valid only for 1 year. So come 30 June, you go back into the next period. You start your next financial year's application again. Again, realize with this, it's not an automatic grant from the ATO. They will have a look at it. They will ask questions about it. They will assess the situation before they grant the application.
Yes.
Once that's done, they will contact your payroll officer and say, right, we've accepted this, we've accepted going to vary the rate down from this marginal rate to that marginal rate, put your money back in your pockets. The consequence of getting the application wrong, it is difficult to do as an individual. If you get it wrong and you're more than 10% out, you can be liable for fines and penalties. So you do have to be reasonably accurate with these things. Certainly during construction period, it is more difficult because we don't know when the property will be completed. So these
coming in.
Absolutely right. Absolutely right. So we make a conservative estimate of that and we explain it to the ATO at the time. So be very wary of those things. It's worth paying a couple of dollars to go to the ATO, to the accountant, and get it done right the first time. Perfect. We do have a simple example here for you to have, where you can have a look at the benefits of a PAYG variation. In this particular scenario, we've assumed that you've got an investment property of 400,000 with the following income and expenditure. We're saying you're getting 365, which Out behind subsidizing that property, you've got your interest. Calculated in this particular example at $519.23 a week, or $27,000 annually. You've got your other expenses, which may be your property management fees, that sort of thing, which we've calculated in this example at $76.92 or $4,000 at the end of the year. Your net cash flow or outflow in this example is $231.15 a week, or $12,020 annually. As we said in the previous slide, you can either wait until the end of the financial year to claim back that $12,000, tax on that $12,000, or by putting into place a PAYG variation, we're going to part 2 of the case study. Slide quickly. Oops, there we go. All right. Next one. That's it there. Again, the principles of the slide can stay exactly the same. In is the same, your expenses going out are the same, with the exception of the fact that we are now claiming a depreciation deduction on this particular property, which equates to $9,000. That is essentially $173.08 a week. Now, by taking that cash saving into account, so it's not a cash flow item, but it is a saving on your property of $173 that week, your pre-tax outflow comes down to $57.07 for the week. So you've already saved $172.85 per week on this rental property. That's the type of money you can be putting aside for that rainy day in case something goes wrong with the property. You need to spend some money to restore something, got bad tenants that have destroyed it and needs to be replaced, that sort of thing. It's just a bit of a cash flow. Plus, and obviously on top of that, because you've got your PAYG variation in place, you're paying less tax on your normal earnings every week, fortnight, or month, depending on your scenario, at your marginal rates. So the base in this example is a saving of $173. The important thing to note with this, though, is obviously this PAYG variation is only available to employees. You cannot get this as a self-employed person because you're not drawing wages. Yes. So it's just for people who are on the PAYG system that will be able to enjoy this benefit. All right. Generally, it takes about 2 to 3 weeks for us to prepare these schedules for you. We then send it through to the ATO, who will process it. That can take probably about 4 weeks, depending on how busy the ATO is. So we suggest that, keeping in mind that we're going into a new financial year, now's the time to be doing these schedules for 2020 financial year. Get onto them now and start making your cash savings now rather than waiting until the end of the financial year.
Good, thank you very much for that, Mike. A couple of questions have been coming in. So this is the first question that's come in. Mm-hmm. This attendee tonight is saying, to reduce my tax, should I purchase an established older property or a brand new property? Any ideas on that one?
Absolutely. Garth, you're always better off buying a brand new property. You're going to have far bigger capital depreciation. You get 2.5% over 40 years.
That's on the building?
That's on the building, that's correct. Then you've got your depreciation on the contents, which are now brand new. It's modern stuff, everything's in there. When you're buying an established building, obviously it's already been depreciated, it's got less value in terms of depreciable value. Yes. The contents are that much older, so your depreciation value is going to be less as well. As we said prior, any second-hand or used goods within the property are not depreciable at all.
So that comes down to the weekly cash flow, because we can get more tax deductions. It should make the property a bit more cash flow positive. Absolutely. Being a newer property. And also from our side, we recommend that too, because they don't have, new properties will be under warranty periods and guarantee periods for anything going wrong, whereas a second-hand property, it's out of warranty, and if something goes wrong, you've got to replace it quickly because there's a tenant in there and you have to find the money.
Absolutely right. That's it.
Right. Second question that's come through. To reduce my tax, should I buy the property in my name or in a trust or in a company name? Any thoughts on that?
Ooh, that's a big one, Garth. Not really able to give a definitive answer on that because it depends on your personal circumstances. Everybody's different. Everybody's going to have different ideas behind this. Have a conversation with your accountant. your stamp duties are going to change, the tax implications are going to change. It's a very, very individual and a unique thing to each individual person. It needs to be taken on each on their own value.
And would it be fair to say it depends on what the investor's strategy is?
Yes.
If you're going to buy and hold long term, there may be a better way to do it. If you're going to buy fixed properties, renovate and resell, it might, those different, what your strategy, different strategies are going to need different vehicles, right?
Absolutely right, absolutely right. If you're going to buy to renovate and flip, you're going to be seen as a property dealer, it's going to be a business.
Yes.
Whereas if you're buying to hold, you're a true investor.
Yeah.
So different tax implications.
So a property trader or a property investor. Eh?
Absolutely right. A very, very big difference.
All right. Questions are coming through, which is fantastic. Here's a third question now. Might be our last one for the evening because we're a little bit tight before we have a little recap. This question has come through. My wife earns part-time. She works part-time. She earns $20,000 per annum. And the partner is earning $120,000 per annum. The question is, should we purchase the property joint? This is an investment property. Should they buy joint tenants 50-50? And the main strategy is he's trying to get the tax down. So one of their main things is that they're looking to reduce the tax. The wife is on $20,000 a year and the husband's on $120,000 per year. Should they buy it 50-50? Any ideas there?
No. Generally, if your strategy is to try and save tax, certainly the higher income earner would want to get those deductions. It makes more sense to put it through the person with a higher value. Again, personal circumstances will dictate, but the critical thing here to realize is don't buy a property to save tax. You're going to speak to Garth to find a property that's going to get you capital growth, that's going to give you long-term wealth. Buying something like, to try and save tax this year, your wife next year or your partner next year may earn $50,000, $60,000 more. Something may happen, you'll be earning less. So you could be stuck in a situation where you've got the strategy that you put into place today doesn't work tomorrow. We need to think long-term sort of strategies behind this. It's not a day-to-day type of plan that puts it into place. We do have to look long-term. Certainly, at face value on what you've given us there, yes, it makes sense to have the bulk of the earnings in the higher earner. But as I said, think long term. If it's a lady that's earning that type of money, she may want to go on to maternity leave. Her earnings may drop, that type of thing. So it's a long-term plan that needs to be taken into account.
And Mike, at Property Powerhouse, that's definitely one of the main strategies we promote is to buy and hold long term. And tax is a byproduct of what you're actually doing.
Absolutely.
So tax is important, but we don't believe it is the most important, and it shouldn't be. Fundamentally, we come back to a quality property in a quality area where a quality tenant would want to live. And it doesn't mean that they have to pay, it doesn't mean it has to be an expensive property with expensive rent, but that's what our job is, to research the market nationally, create some opportunities for different clients. Some may want to reduce tax, others may need the property to be cash flow positive.
Sure.
And that's why we really encourage the clients and anybody investing in property to have a strong team around them. Your finance brokers and a very important person in that team, a property consultant or mentor, someone helping you on the day-to-day that has properties and understands property, talking to their accountant, talking to their settlement agent, making sure that everybody's on the same page and that we're all going in the same direction for the same outcome.
Absolutely right. Absolutely right there, Garth. And you've got the right strategy by having this power team that you're working. Everybody talks together. Everybody works towards the same goal. You like to get the right outcome at the end of the day. Absolutely.
All right. So just winding up, just to reinforce basically what our roles are. So Property Powerhouse, we're the experts in investment property, and our role is to help educate and guide clients through the whole process of purchasing and holding a property long term. So we help them with assisting with their finance. We help assist them with cash flow analysis and estimations. We help them with property selections. We help them with property settlement, property management, insurances, depreciation schedules, and we have good preferred partners like yourself on the accounting side that we know that are tried and trusted people. So
thank you.
That's that's where we hold their hand and hold them through the process to hold long term and hopefully buy multiple properties. Just in wrapping up tonight, what would you suggest as moving forward from today, if somebody finds something of interest? I mean, the PAYG variation form is very much of interest, and we
Absolutely.
very much encourage our investors to look at that to help them with cash flow, get the money sooner rather than later.
Absolutely right.
What would be the next step if somebody was interested in learning some more or actually implementing the PAYG?
The best is give us a call, make an appointment, come and see us. If you're interstate, we're happy to talk to you on the phone. Our details are on the screen there at the moment. Our email address is mike@assetfinancialaccounting.com.au. You can get us on the mobile number 0421 804 722. We've got a landline which isn't on there, which is 0894097054. We're happy to have a chat with you, see what your particular circumstances are, and see how we can help you. And if you decide to proceed with the PAYG variation, we will walk you through that and show exactly what needs to be done and how we can achieve that result for you.
Yeah. And it doesn't matter where they are around the country, you'll be able to service them and be able to assist them with that.
Absolutely right, Garth. Yeah, we certainly with the internet, being able to transfer files across the internet, that type of thing is quite easy. We don't have to see the client face to face. We can do a Skype meeting, we can do a telephone meeting. It's technology is on our side with these things. So very, very easy.
Excellent. Well, we're 1 minute over, so I think we're going to call time out there. And what we're going to do is we just want to say thank you very much for being on the webinar tonight, Mike, and for your words of wisdom. So thank you. What we will be doing at the end of this now is we will have a recording. So I've got your email addresses, attendees. So I will be emailing out also a recording of the webinar this evening. We thank you very much for being on. We are planning to run these every month or every second month moving forward. I will be asking for some feedback. I believe some of the audio has been a little bit up and down, so we do apologize from this side. I'm going to put it down to the cold weather in Perth. We're having a freezing night, and I'm sure a lot of you are feeling the cold we are around the country. But an important time to actually engage with your accountant or have a chat with Mike, give him a call, think about tax, particularly this PAYG variation. It's good to maximize it for the full financial year. So you want to get that in before 1 July and maximize for the full year. So in closing, thank you very much, Mike, and thank you very much for our attendees.
Thank you very much. Thank you. Have a good evening.